How should your investment strategy change as you age? What are the key considerations for managing risk and return in retirement? Here we go. Welcome to the Forget About Money podcast, where we encourage you to take action today so that you can focus on what matters most to you. Today's guest is William Bernstein, a distinguished financial theorist and author renowned for his groundbreaking works on investment strategies and economic history. With a unique background as a neurologist turned finance expert, Bernstein has written influential books like The Four Pillars of Investing and The Delusions of Crowds, offering invaluable insights into the world of investing and behavioral finance. Welcome, Bill.
Glad to be here.
Bill, today I thought we would take the accumulation of your knowledge, experience, and passion for helping others and have a discussion about investment strategies for different life stages. Who we are, what we value, and our available capital change over time. And we should account for those differences over time in our particular investment strategies. This conversation will cover investment strategies and principles, economic and historical context, and behavioral finance and psychology as we address the adolescence, early adulthood, middle adulthood, and later adulthood life stages. Bill, again, thank you for being here, and let's get right into it. There's an idea out there for investing strategy that is represented by something called life cycle investing. Why is that crucial to tailor investment strategies to different stages of life?
The bedrock of personal investing is your capital structure. And what I mean by that is if you're a young person, you have an enormous amount of human capital, probably a couple of millions of dollars of salary and income that you're going to have over the course of your life. Your amount of investment capital, unless you're an heir or an heiress, is going to be much, much smaller than that. So if you look at your investment capital, it's only a couple of percent, if you're under the age of 30, of your total capital. And so theoretically, at least, you should invest almost all of that in stocks because your human capital looks like a bond. It's basically a stream of fairly steady income that's hopefully increasing at or above the rate of inflation. So it really doesn't matter what your investment capital does on any given date for two reasons. Number one, if you have a date like you did on Monday, August the 5th, which is the day after we're recording this, when the markets fell by several percent at some point, it really doesn't matter at all for two different reasons. The first reason is because it's only a very small part of your investment of your total capital. And the second reason why it doesn't matter is you're not going to need the money for 30, 50, 70 years. So what does it matter what it did on one particular day? Now, the older you get, the more important your investment capital becomes until the point where you're a retiree and you have no more human capital left. You might have a stream of Social Security or pension income if you're lucky, but you don't have any real human capital left. And so you have to be much more careful with your investment capital, that is the amount of stocks and bonds you have when you're retired. So that's the basic concept, is your human capital versus your investment capital and how that changes as you get older.
I think a lot of that makes sense, especially when you start making money. You're at your first job, usually in your 20s. But what if you're before your 20s? What about adolescence? At what age should financial education begin, and what basic principles do you think adolescents should learn to prepare for a future financial independence?
Well, the comment that I'm going to make is basically directed towards parents. And what I like to say is that the single most important bit of financial education you impart to your children is what they see you doing. So if you live in a McMansion and you're driving a 8 Series or a 7 Series Beamer, and you're flying first class or worse yet, private, you've sent a message to that kid and you may very well have ruined them for life. So it doesn't really matter, or it matters less what you say than what you do and what your kids see you doing. Now, when should you start a child financial education? An easy way to do that is to start a small custodial account when they get to be 9, 10 years old. And maybe once a quarter have an investment meeting. And if they made money, they get to keep half of the return on that to spend on the things they want. And if they've lost money, well, better yet, you've shown them that markets can move down and it doesn't affect their standard of living or their style of living. And you do that for some years. Now, the real question, and this is a very deep question that academics have spent some time looking at, is when does it pay to start providing formal financial education, teaching a kid about finance? And the answer to that is probably not until the later years of college, the junior or senior year of college. Because unless you're managing a checking account and a bank account or a credit card, it really doesn't do much sense, really doesn't make much sense to be talking about stocks and bonds. So you save that for later in a kid's education.
I think about my own adolescence, and I made my own money and I saved money, but I didn't know too much about investing, and I didn't get any education in high school for it. But my father did promote and encourage us to save 80%, which we did. He didn't tell us what to do with it after we saved it, so we ended up spending a lot of it eventually after it was saved. But even that, I think, is probably more than most kids get through their adolescence. At least I knew the concept of saving. And then that, I think, just the idea of even working with money interested me enough to just start reading books in my late teens, early 20s regarding finance. But everybody's different. Every family's different. Everybody's got different dynamics. So it's interesting how you talked about the transition to formal education. And that's actually surprising to me because right now we've got many high schools beginning mandatory financial education. I think more than 21 states are already mandating it. So it would be interesting to close the gap between why experts think that financial education formally should be given at junior or senior year of high school or of colleges rather than high school. So let's talk about early adulthood, which for the sake of this conversation is going to be ages 19 to 45. Now, I would probably make the case that early adulthood probably would be sooner. But again, that's my perspective as a 46-year-old. And I probably don't feel like I'm very much in an early adulthood right now. You described human capital as a bond. Is that right?
Yeah, it behaves like a bond. Human capital is basically a stream of income, which is basically how a bond behaves.
And how should this influence investment strategies for young adults? That is, again, people from their 20s to age 45.
Well, if almost all of your capital is human capital and that behaves like a bond, then you really can't invest too much in stocks. And in fact, at least from a theoretical point of view, there are people who say that a young person should be leveraged 2-to-1, 3-to-1 in stocks, which I think is insanity. But at least there's a theoretical argument for doing that, which is that if you've only got a $10,000 IRA and you've got $2 million of human capital ahead of you, and you leverage that $10,000 to up to $20,000 or $30,000 with borrowing, you still only have a couple percent of stock exposure. That's the theory. In practice, there aren't very many beings in this quadrant of the galaxy that can tolerate, 100% leverage or 200% stock exposure, let alone 100% stock exposure. For most people, even 100% stock exposure is probably more risk than they can tolerate on a day-to-day basis.
Why is it important for young investors to invest heavily in stocks? And how can they manage the associated risks that you just mentioned?
Well, it's important because the risk of stocks is actually decreased when you have a stream of savings. So if you're a young investor, you want an awful stock market for almost, the first half or 3/4 of your investing career so that you're buying stocks at very low, depressed prices. So stocks are actually, if you think about it, less risky for young people who have a stream of savings. Now, the exact opposite is true, of course, if you're retired. If you're retired, stocks aren't just risky, they're 3 Mile Island risky. And so that's the most important thing to realize about how the life cycle affects that. Now, the problem, of course, is that most young people aren't able to psychologically handle watching that $10,000 or $50,000 IRA fall in half during a bad year. And that can happen, all right? And the important thing for that person to realize when that happens to you is, don't worry, you don't need the money for 30, 40, 50 years. And so there'll be plenty of time for that to recover.
How do you balance the lifestyle of what normally goes on for someone in their 20s and 30s and maybe early 40s. And there are significant differences in those 3 decades, I think. What factors should someone consider when they're deciding how much to have in stocks and how much to have in bonds as they go through those 3 decades?
Well, to start out with, you start with the young person who theoretically should be 100% in stocks with their investment capital. And what limits that is what their actual risk tolerance is. So the worst thing that can happen in that situation is the person thinks they're risk tolerant. They start investing during a bull market. And then one fine year comes along and they can see that they've lost 50% of their money. And the question is, how did they respond to that? And that's a very individual thing. I know people that's happened to. It didn't bother them at all. They kept buying more stock all the way down until stocks finally recovered. They didn't lose any fleet. On the other hand, I've seen people who, risked their lives in combat, who threw up when their stock portfolio lost 10%. Okay. So the question is, where do you fit on that? Are you someone who is extremely sensitive to risk or not? And you don't know the answer to that until it's actually happened to you. So what I generally counsel young investors to do is start at, with a 60-40, a 50-50 stock bond portfolio. And then a bad bear market comes along and that will teach you what your actual risk tolerance is. And it'll happen to you soon enough. It'll happen to you probably within the first 10 or 15 years of your investing career. If you're lucky, it happens to you the very first year of your investing career. And you find out early what your actual risk tolerance is. So if you were really bothered by it and you lost sleep, maybe you're a 40-60 person. Okay. If on the other hand, you dove in with both feet or both hands and you bought stocks and you did well, then you're a 100-0 person, at least for that portion of your early life.
Yeah, I like that. That's a practical process to go forward because we see these, online questionnaires that are supposed to determine your risk factor. But like you said, you never really know until you watch that portfolio drop a significant amount. So I like the idea of starting 60-40. I think that's a conservative approach. Probably any starter, no matter what age, 60-40 approach. And then after a couple of years, either just up or down based on just how you feel about it and your performance.
The analogy I like to use is that a spreadsheet or a risk profile is kind of like a flight simulator. It can crash all day long in a flight simulator. It doesn't bother you at all. You're going to respond very differently if you're piloting an aircraft in a very bad situation than you did in the sim. It's the same thing with investing.
So let's transition into the middle adulthood, which is, for the sake of this conversation, ages 46 to 65. So many, in particular in the financial independence community, has already built a net worth such that they could retire early. So if we could, can we talk about the traditional retiree and the general financial independence retire early person? So it's probably like 2 tracks in this middle adulthood age group.
Well, the way I like to approach that question, because it's a very difficult question, is to ask what is the goal? And the goal is simply to have enough safe assets to retire on. So if, let's say, you've decided you need $1 million to retire on, that $1 million should be largely in relatively safe assets, because if they're in risky assets and those risky assets do very poorly in your retirement, then you're going to be significantly constrained. So the goal that I like to see is for someone to have enough money to meet their basic living expenses after they've paid their taxes and after they've gotten their Social Security and their pension and whatever else they're going to be getting when they're retired, to safely take them to, age 85 or 90 or even 100. And once you've acquired or you're approaching that amount of money, the obvious thing to do is to start cutting back on your stock allocation and to invest in fixed income assets. Now, I'll probably get a little later on into what those fixed income assets look like. But that's the hardest part. That's the most difficult stage of investing. And what I like to say is that when you've won the game, you should stop playing the game. It doesn't mean selling all of your stocks, but it means to start bailing some of the risk out of your portfolio and do it slowly and gradually over the years after you've convinced yourself that, you do have enough to retire on. Because the worst thing that can happen to you is you retire and then the first 5 or 10 years of your retirement, your risky assets start to decrease significantly in value.
So this is where I've seen the conversation go in one of two directions. You've got some people who say and argue the math, just as we stated earlier, that if you're young, you should be a high percentage in equities or stocks. And so I wonder if at this point, the question becomes, what do you want the money to do after you die? Because if let's say you're 60 and you live another 30 years, yes, you could create your income floor through very conservative asset classes such as a SPIA, which we'll talk about, or maybe got a pension already, those things. But again, the math, at least historically, says you should still maintain a significant portion, and if you want growth, significant portion in equities over time. So I guess you have to decide what problem you're solving for at this point. You have to decide, okay, do I want to leave as much money as I can to my heirs, or do I want to ensure my own 100% safe retirement? Is it an either or? Is there some kind of balance between?
Well, it's like everything else in economics, which is it's a trade-off. So the less you spend, the lower your burn rate, the smaller percent of your assets you're spending every single year, the safer you're going to be. But of course, the less you're consuming. All right. And you have to decide the whole concept of where you fit on, on the one hand, you want to leave bequests. On the other hand, you want to be safe. And how do you trade that off? And I know people who really, don't care that much about their heirs. Maybe they don't have any children, and their nephews are spendthrifts and they don't want to leave them any money, and they care about only safety. Well, that person should have a higher percent of bonds than the person who wants to endow their children with a lot of money or wants to endow a wing at the hospital. That requires you to invest more aggressively. Now, this gets to a really important concept in retirement. If you're really lucky, you get to the point where you have enough money to meet your basic needs for the rest of your life with safe assets. What do you do with the rest of the money? Well, that's a risk portfolio. And the thing to realize about that risk portfolio is that, yes, you can invest it in risky assets, but at the end of the day, it's really not your money, okay? Because you're not going to wind up spending it. That money is either going to go to your heirs or to your charities. And so I tend to look at them as two separate portfolios. One of them is what I call a liability matching portfolio, which matches your living expenses every single year. And we'll talk about how you do that. And then the other part of the portfolio is the risk portfolio, which is the stocks and the bonds, which, maybe you will splash out on a Beamer or fly first class every now and then. But more likely than not, that money is going to people after you're gone.
Okay. I like the framework of the liability portfolio and the risk portfolio. And that reminds me of a conversation I just had with Stan, the annuity man, and he educated me on annuities. I knew nothing about it. I did have a negative bias towards it, but I've since adjusted that perspective. So liability versus risk portfolio. The liability, again, is the setting your income floor, you're covering your living expenses, and however you projected that out for your own life expectancy. And then the risk portfolio would be the action portion of your portfolio, the stocks, the whatever else you've got going on that's a little bit more volatile and not fixed income or set returns. And in that conversation I had with Stan, he mentioned that most annuity salespeople don't, or at least you have to justify why you would want to put more than 50% of your net worth into an annuity. And in many cases, he says it's like a practice that's not even expected. So before that, I thought you could put as much as you could into an annuity. And maybe there are some special cases, but he said as a practice, they don't allow you to put more than 50% into an annuity. And for me, I think that's kind of in line with it could be in line with your liability versus risk portfolio kind of theory. Is that how you see it practically play out when you have clients or people having this conversation with you?
Yeah. Now, here's the way that you should think about it. Let's assume that after you've gotten your Social Security payments, you need $50,000 a year on top of that and on top of your pensions in living expenses. All right. And they're going to be, that's $50,000 today. Now that's going to go up with inflation. So what is the best way to cover that? Well, the very best way to cover that is with a ladder of real bonds. All right. Bonds that increase their value along with inflation that mature every single year. And if they mature every single year at $50,000 per year, then you have covered your living expenses. All right. And we are very fortunate in this day and age that the U.S. Treasury actually issues such bonds. They're called TIPS, Treasury Inflation Protected Securities. And so ideally, you would have a ladder of those going, all the way out to the point where you're pushing up the daisies. Now, there's a couple of problems with doing that. The biggest problem is you can only buy them in maturities up to 30 years. Now, if you want to retire at age 55, then that ladder will end when you are 85, and you'll have a little bit of a problem. So that's the first problem. There's another minor problem, which is that at the present time, there are no maturities between 2035 and 2039. So that's the ideal way to do it. Now, you can solve that longevity problem by buying a SPIA, a single premium immediate annuity. The only problem with SPIAs, actually, there's two big problems with SPIAs. The very first problem with a SPIA, an annuity, is that they're nominal. You used to be able to buy real annuities or inflation-adjusted annuities. You can't buy them anymore, and the reasons for that are complex. So the initial payout, you may be looking at $50,000 worth of income from your annuity in year one, but 30 years from now, that may be funny money because it's nominal $50,000, doesn't increase with inflation. The other big problem with annuities is that they are issued by insurance companies, and insurance companies carry with them credit risk. Insurance companies have failed. There is a theoretical backup at the state level for insurance annuity contracts, but in a bad state of the world, you're going to blow through that. The states will blow through that like a knife through hot butter. So that, there's pluses and minuses to both SPIAs and TIPS. There'd be nothing wrong with splitting difference and putting some of your assets into a SPIA and some of your assets into a TIPS ladder.
What percentage of your overall portfolio would you recommend in these types of asset classes?
That depends upon how much money you're burning every year. It's not how much of your portfolio do you put in them. It's how much of them do you have to buy to maintain the income you need. So that example I just gave, you need $50,000 worth of income per year. Then to last 30 years, you would need, really about $1.2, $1.3 million. And so if you've got a $5 million portfolio, then, you've got $3.7 million to go into the risk portfolio, and you can invest that however you want. If, on the other hand, you've only got $1.3 million, then you want to be putting most of your money into that liability matching portfolio. Because if you put it into a portfolio that's stocks and bonds, and you get a bad sequence of returns, you're going to be in a world of hurt fairly shortly.
So, over the last few questions, we've clearly gone into the later adulthood stage, which is, I guess, marked by probably Social Security. Age 60 to 65 is probably what someone is transitioning into the later adulthood stage, and it's marked by getting an annuity, which was Social Security. And a lot of people don't recognize Social Security as an annuity, but it is. And luckily, that's actually adjusted for inflation, unlike a SPIA.
By the way, deferring Social Security to age 70 for the maximum payment is the best annuity that money can buy. It's better than any commercial annuity because it is adjusted for inflation. And for every year that you delay taking Social Security beyond your full retirement age, whether that's 66 or 67, you're going to have a 7.5% or an 8% higher monthly paycheck. And, when you're very, very old, that may be the difference between a comfortable retirement and eating dog food.
Yeah, that is significant. One thing, and I have not run the numbers, but one thing I want to explore is what if I took, let's assume I didn't need to spend any Social Security and I began taking it at the earliest possible, and I just took that and I put it into a broad market, low cost index fund. Would that make a difference in a good way? Because then you're getting more on your side of the ledger earlier on. I don't know. I haven't done the math, but that's something I want to explore. And I'm sure somebody else has done it, and I just haven't researched it.
Depends upon what your time horizon is. You have to understand that over periods of up to 2 decades, stocks can have zero real returns. And below, 15, 20 years, stock can have negative real returns. And you have to ask yourself, do I want to take that risk? By the way, if you want to decide what's the very best age to take Social Security, or more importantly, if you have a spouse, how to game who takes the Social Security when there's a wonderful website run by a guy by the name of Mike Piper, who I believe it's opensocialsecurity.org. I think that's the name of the website. But look up Mike Piper's, just Google Mike Piper's Social Security calculator, and his calculator will come up with a pretty darn good strategy for you and your spouse to cover.
Yeah, thank you for that. I definitely need to get smarter on Social Security, as do probably many other people, especially those who are trying to determine what enough is if they're retiring long before they actually start Social Security. How are they going to work that into their plan? One of the guiding principles in the financial independence community is the 4% rule, safe withdrawal rate. And you already mentioned that if you run into trouble your first few years of retirement using the 4% rule, you have a market downturn, and that is the definition of a sequence of returns risk. Do you agree with the 4% rule? How do you use the 4% rule, if at all, when you're advising a client?
Well, it's a good rule of thumb. And the 4% rule is merely the inverse of 25 years. So I tell people you should have 25 years of living expenses saved up. Well, that's 4% per year, 1/25th per year. Now, if you want to retire at age 40, a 4% burn rate may be a very big risk. If, on the other hand, you are 70 years old, then you can probably spend 5% per year. The easiest way to think about that is to think about a tips ladder that goes out 30 years. Now, if you amortize the current interest rate on tips, which is roughly 2%, and you take a mortgage calculator and you amortize that out to 30 years, that means that you can spend 4.5% per year before your money finally runs out. That's the way the mortgage calculation falls out. Now, I'm 76 years old. And, 30 years from now, I probably don't have to worry about that. But if you're trying to retire at age 40, then 4% or let alone 4.5% is probably a bridge too far. Maybe you should only be spending 2.5% or 3% if you really think you want to retire at age 45.
There's definitely a lot of psychological and behavioral aspects with money over time that when I'm 46, which I am right now, I think differently than when I was 32 or 22. And I'm sure it'll be different, a decade from now. What behavioral challenges from a behavioral finance and broader insight perspective do investors face at different life stages, and how can they overcome them?
Well, the basic problem that human beings have is that we're risk myopic, which is that we pay too much attention to short-term returns and we don't think enough about long-term returns. And if I can get into a little bit of evolutionary psychology, we evolved at a state of nature where our risk horizon might be a fraction of a second long. If you're in the military, it might be a fraction of a second long too. And so your responses are very much attuned to short-term risk. On the other hand, we now live in a post-industrial environment where the biggest risk for you is running out of money. And that's a risk horizon which is decades long, up to 50 years long. And the analogy I like to use is that of a skunk, which over millions and millions of years has evolved a very effective strategy for dealing with risk, with predators, which is to turn 180 degrees, lift their tail, and to spray. All right. That's a very effective response if you're a skunk in a state of nature. On the other hand, if your major threat to your existence is a hunk of steel moving at 60 miles an hour towards you, then that is not an effective response. And that's the situation that investors find themselves in, is they did not evolve to deal with finance in an effective way at all. Basically, we're living in a space age world with Stone Age minds, and that's our problem. So how do you deal with that? And the way you deal with that is you educate yourself about behavioral finance. And the best way to do that is to, first of all, read about it. And I'll plug one book by a guy by the name of Jason Zweig called Your Money in Your Brain. He's a Wall Street Journal reporter. And that book, it's an excellent book about how dysfunctional our brains are and how to deal with that. And the bottom line is that, we have two systems. We have a reptilian brain, which is our system one, which is, how we come to decisions, risk decisions very quickly, disgust, fear and greed, all that sort of stuff. And we've got our, wonderful system two, our rational brain. And the trick is to train your system two to hear what your system one is telling you. And my favorite aphorism for that is the best investment decisions I've made and the best purchases I've made have been made while my system one was telling me to throw up.
Can you give an example?
Well, that example is the way that I felt about investing in late 2008 and 2009. I'd watched my risky assets fall by almost 2/3, and yet I was still buying more. And let me tell you how bad that felt. It felt like exactly the wrong thing to do. But I had learned over the decades previous to that that's exactly what you should be doing when the markets are behaving badly. And that's where something else comes in, which I think you probably want to ask me about, which is the importance of investing history. Just as you have to learn about investing psychology, you also have to learn about investment history to learn that you're not the first person to experience a bear market, and that eventually bear markets turn around, and that in fact, the very best times to invest are when the sky is the darkest, and the very worst times to invest are when there's lots of sunshine out and everybody's optimistic.
How would you characterize the market right now?
Well, until about 2 weeks ago, it was the sun was shining. There were a couple of sprinkles in the sky yesterday. Today, the sun's coming back out again.
You've written a lot of books, and many of them have historical context. I'm not sure how deep you get into the social inequity piece, but in a country where it seems like we're divided along any line that can be drawn, how do societal inequality and the radius of trust influence investment outcomes and financial strategies across a person's lifespan?
Well, those are two very big subjects. Let's talk about radius of trust. Radius of trust is how much trust people have for strangers. And in modern Western societies, that radius of trust is fairly high. You can, go and deal with strangers behind a cashier's counter, or give your credit card number to somebody over the phone, and you are reasonably trusting and reasonably assured that person will not cheat you. That's going to be true 99.9% of the time. That's not the way it is in all societies. From an investor's point of view, it's really good to live in a society where there's a high radius of trust, because where there's a low radius of trust, it's very difficult to invest well, and security returns tend to be very low in societies with low radius of trust. And so, there's a reason why over the past century or 2 centuries, securities returns have been the highest in English-speaking countries. Why? Because English countries have a common law that protects property rights and protects people in contract. All right. That's not the way things work in much of the rest of the world. Now, you asked a question about inequality, which gets to be a very, very difficult and politically fraught question. But the one thing that is absolutely true is that inequality makes people miserable. Okay. When, the person next to you is driving a BMW, and your next door neighbor is driving a BMW and you're driving a clapped out Toyota, that doesn't make you feel as good as if your neighbor is just driving the same Toyota. People don't like inequality. And I'm not sure that has anything to do with investing, but it is a fact.
I wonder how it might impact someone's investment decisions, though. I want to think, does this fall into the keeping up with the Joneses, maybe, or if there's more, I don't know, dichotomy between different societal groups?
It gets to the relative importance of saving versus investing. Okay, we're talking about investing, but far more important than investing is savings. Your name can be Warren Buffett, but if you can't save, it doesn't do you any good. And the most important thing you can understand about money is not that it buys you things. If your idea of money is that it enables you to buy a fancy car or a bigger house, then you probably lost the game. The purpose of money is not to buy things. The purpose of money is to buy you time and autonomy. And that is the single most important thing you can understand. And it's to resist keeping up with the Joneses. If your next door neighbor, you may see that your next door neighbor has the BMW, and maybe that person, maybe not, but maybe that person just went into debt to buy it. you're in much better shape than that person is going to be. And what I like to say, and I hope I don't offend too many people when I say this, is that a BMW or a Tesla is not a motor vehicle. It's an IQ test.
Hmm. Well, if that rubs people the wrong way, maybe this next one will get them too. In your writing, you mention religion, how religion and countries affect their economic, like, I don't know if it's status or environment. But can you elaborate on the paradox of religion affecting individual and national economic health and what kind of implication it has on investors?
Well, I don't think it has much to do with investing except in extreme cases. But the subject of religion fascinates me because when you stick strictly to the sociological data, okay, what you find is that religious people are happier, they live longer, they are more connected to the people around them. Okay, so in the individual case, religion is a real positive. But when you look at it on the national level, the exact opposite obtained. The most religious places in the world, the most religiously oriented countries in the world, are the ones that are the poorest, they are the most violent, they have the worst quality of life and the lowest well-being. So if you rank countries by how religious they are, and you can do that fairly easily, and you look at well-being, you see that there's a very strong negative correlation. So it's sort of like Keynes's paradox of thrift, which is thrift is good for the individual, but it's bad for the macro economy. If everybody saves, then you get a depression, all right? And it's the same thing with religion, which is that it's good for you personally, but you don't want to live in a country where people are religious fanatic or very strongly religious, because you're going to be living someplace like Pakistan or Somalia or southern Italy, where there's a low rate, and this gets to radius of trust. Very religious societies tend to be societies that have low radius of trust.
In all of your writing across, I believe you published your first book in 2000 or 2002, in all of your writings and all of your experience, what are the most either novel or impactful ideas that you've explored and then tried to push out for the benefit of others?
Well, the first is what I talked about with the skunk analogy. It's just how irrational we are. We have this system one, which is our reptilian brain that reacts emotionally with fear and greed and disgust and pleasure to the things around us. And then we have our system two, which is our rational Cartesian brain. And we tend to think that we're ruled by our system one. But in fact, as Danny Kahneman liked to say, the late Danny Kahneman liked to say, our system two is just the press agent for our system one. We come to our conclusions and our decisions about life using our system one, our reptilian brain, and then we use our system two to rationalize it. And then the thing that I wind up most being fascinated by is by evolutionary psychology, because it explains so much about human behavior, about human history. If I had to recommend one book about that to people, it's a book by a guy by the name of Joseph Henrich, Henrich at Harvard University, called The Secret of Our Success. He actually wrote two books. One is The Secret of Our Success, which connects evolutionary psychology to human behavior. And he also wrote a book called The Weirdest People in the World, which is about Western society. Western society is what he calls weird. And that's an acronym, not the term the way that Tim Waltz just used it, but it's weird stands for Western educated, industrialized, rich, and democratic. And what you realize, and what Henrich makes you realize, is that that is only a very, very small subset of humanity. Most other people in the world live according to what he calls a traditional moral structure, which is completely different than the weird moral structure. And we're weird. We are the Westerners are the ones who are weird. So I would read him. And then there's another book that I would recommend reading by Robin Dunbar called How Religion Evolved. And it's really not about religion, okay, at all. What it's really about is more about, in religion, it's about spirituality, and it's about human communication and how we use our brains to organize social structures, and not at all about religion. Don't let the titles turn you off. Robin Dunbar is a brilliant man. He's got a number named after him, which is 150, Dunbar's number, which is the number of social relationships that a human being can keep straight. All right. And beyond 150, you can't do it. And the reason why that's such an important number is because if you have a tribe, an Aboriginal tribe, once that tribe gets to be more than 150 members, it falls apart because people can't keep their social relationships straight. And so the tribe will fragment into 2 or 3 different tribes. And it's how he arrived at that number was even more interesting, which has to do with neurophysiology. It's just fascinating stuff. So that's the stuff that really captures my interest these days. Has nothing to do with investing at all.
You transitioned from being a neurologist to a financial expert. What are the linkages, if any?
And almost no linkage. People think that as a neurologist, I have some special expertise about human neuropsychology, and I really don't. I was a clinical neurologist, and clinical neurologists, for the most part, spend very little of their time dealing with deep neuropsychological issues. It's much more mundane things like headaches and multiple sclerosis or neck pain and back pain, things where there's, not a lot of sophisticated neuropsychology involved. What really helped me with the transition is just my basic scientific training, which is before I went to do medicine, I was an organic chemist, and I inhaled the scientific way of looking at the world. And there is a scientific way of looking at investing. And so I live in a country that doesn't have a functioning social welfare system. I was going to have to save and invest on my own for my own retirement. And I approached that in the way I thought that any scientist would, which would be to read the peer-reviewed literature, collect data, build models. And after I had done all those things, I realized that I had done something which was of value to ordinary investors, and I started writing about it.
And then the rest is history.
I guess, yeah. Well, that's the tagline, because in order to invest properly, you have to understand history. And I found that I enjoyed writing about history even more than I enjoyed writing about investing.
You clearly have a lot going on in your mind, I think. I mean, there's some people who are very strict, like money and investing type stuff, but I think the definition of wisdom is learning a lot about a lot of things and then figuring out where they overlap and then practically putting it into use. I think that's like the definition of wisdom. But if you're going to take all of that wisdom that you have right now and stand in front of a group of 25-year-olds in today's economic environment in America, do you think the advice that you give them would have been the same advice that you would have gotten from someone when you were 25?
Probably not. My thinking about investing has certainly evolved over the past 50 years. I mean, 50 years ago, I was watching Wall Street Week with Lou Brookhiser, which, if you know the program, was very much about market timing and stock picking. And it took me 10 or 20 years to figure out that was not a good way for individuals to invest. If I were to stand in front of a group of people, it would be to first learn as much about psychology and investment history as you can, and then pick an allocation of broadly indexed stock and bond funds, or treasuries are a good substitute for bond funds. They're cheaper, and go about and live the rest of your life, and don't focus too much on investing, and to not overconsume.
Yeah, I think I agree with all of that. I wish bigger voices would focus on those things, but unfortunately, the bigger voices usually have a motive to profit from selling products and that kind of thing. So
that's the one thing that's so wonderful about the FIRE community is the FIRE community pretty much has internalized that ethic probably as well as anybody else. There's another community that I'm involved with more than the FIRE community, which is the Bogleheads. Mm-hmm. Who are the followers of John Bogle, the founder of the Vanguard group. And the two groups, there's a lot of overlap between the two, because the Bogleheads are also into not consuming as much as you should. There's all sorts of threads on the Boglehead forum about how to spend only $8 a month on a cell phone plan.
It's interesting. Even you probably see it in the Bogleheads too, and I see it in the financial independence retire early community. There's like a spectrum of frugality, and then you get your Fat Fi group, and then you've got your Barista Fi group, and no matter where you're on that spectrum, you're still far better off, I believe, than the majority of the mass population. So,
but the perennial, if I can interrupt you, the perennial discussion thread on the Boglehead forum is, I want to buy a Rolex. Does that make me a bad person?
Well, what do you think?
Yeah, it makes you a bad person. just kidding.
I got to sell my Ferrari now. Thanks. I appreciate that. What's next for you? What's your next passion project? What are your motivators right now?
Well, we've just talked about the two subjects that interest me most, which is writing about radius of trust and writing about this paradox of religion that I described earlier. And the big question is whether, my publisher is interested in those.
Do you already have the books written?
No, I've done a lot of the reading, but I don't start writing until I sign a contract.
Smart. It's got to be that risk reward. It's got to be that payoff.
Exactly.
Right? Bill, thank you very much for sharing your expertise. Is there anything else that you want to add before we close out here today?
Yeah. The single most important thing about your investment strategy is that you stick with it. You'll see people arguing endlessly. What percent stocks, 1% bonds? Do I tilt the value in small stocks? Do I invest in emerging market stocks? What about REITs? None of that is real estate investment trusts. That pales into insignificance compared to your ability to stick with your investment policy when the excrement hits your ventilating system. All right. So sticking with your allocation, your strategy through thick and thin matters infinitely more than what your precise strategy is. If you want to just, have a 3-fund portfolio, have 3 mutual funds, or even for that matter, a life strategy fund or a target date retirement fund, as long as you can stick with that strategy, even if it's just one well-balanced mutual fund with low costs, that's fine. Okay. Don't stress the percentage points. Don't stress the nuances of your allocation.
And that reinforces a statement I heard from Rick Ferry when I interviewed him on this podcast. And I think I was asking him the question on what's the best asset allocation strategies. And he said, whatever asset allocation strategy that somebody's going to stick to.
That's precisely.
And I believe that was his answer verbatim.
That's precisely right. I can't imagine that I've ever disagreed with Rick about anything, but I can't imagine agreeing with him more about something than that.
Well, thank you, Bill, for sharing your insights on how our investment strategies should be considered as we mature through our life stages. You've definitely given me a lot to think about for my own personal situation, but as someone who likes to help other people with finances, you've helped me give me a more perspective that I can use when I'm having these conversations with people who may be in a different stage of life than I'm in. So I appreciate that. Thank you very much.
And thank you.
And thank you all for watching and listening.